the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares moved higher amid a winning day in Asia. So if we look at the Straits Times Index at about 2 p.m. Singapore time, it was up 1.08% at 4,344 points, with a value turnover of 1.02 billion Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended further in the green, up 1.14% at 4,346 points. Now in terms of value turnover, that's 1.66 billion Sing dollars. Gainers outnumbered losers, 297 versus 252. Now, top advances for today we've got for you DBS, SGX and Great Eastern, and top decliners we've got here GMH USD, UOL, and Jardine Cycle and Carriage. Now, meanwhile, from a record day on Wall Street after the U.S. Bureau of Labor Statistics revised down the number of new jobs in the 12 months to March by a record 911,000, to how DBS shares hit an all-time high to boost the STI to a record. We've got more international as well as corporate headlines in store for you. And joining me on the line today is Audrey Ho, investment counselor, Citigold Private Client at Citibank Singapore. Audrey, welcome to the show.
Hi, Tian Tian. Good to speak with you again.
Great to speak with you again. And Audrey, let's start with the U.S. this time around. We saw this record day on Wall Street with investors optimistic about the odds of a Fed rate cut. That's, of course, as the U.S. Bureau of Labor Statistics revised down the number of jobs in the 12 months through to March by a record 911,000. How would you read into the latest revision as well as investors' reactions, and what's your take on the next magnitude of rate cuts going forward by the end of the year?
Well, Tian Tian, I mean, this is a very pivotal week. In fact, I think the next 72 hours could determine whether or not September stays boring or gets interesting. So you mentioned the 900,000 downward revisions. All things considered, this is slightly better than some of the downbeat forecasts that I've seen of, negative of minus 1 million. But for sure, this labor market softening is the main driver of pickup in the Fed easing expectations, right? So I think broadly speaking, the investor reaction remains quite muted. The S&P closed pretty much flat because we already saw a rally last week following the non-farm payroll data, especially in treasuries. So an interesting point here is that some analysts were postulating that a revision of around 1 million suggests that the labor market already started stalling in quarter one of this year, even before all the trade uncertainty came about, right? So with that, we see broad repricing of rate cut expectations. Citi is looking at 2 rate cuts next week and to end the year in December. But broad markets, they are looking at 75 basis points, although I would say that 50 basis points in September itself is still only at about a 10% probability.
If we go back to Asia, right, Audrey, how did that optimism filter through to Asia? I know we were much expecting a rate cut in September, but it's green across the board with South Korea's Kospi hitting all-time high, Hang Seng up to its highest level in about 4 years. So what are your thoughts?
Yeah, I mean, we see green across the board. I think notably tech sector, semis, all of this is driving the outperformance in Korea, in Taiwan, and in Hong Kong. So AI expansion, largely driving a lot of positive sentiment in Asia following U.S. peers. Like last night, we saw, some tech firms jump double digits on the back of increase in cloud and infrastructure bookings. So if we were to kind of zoom into specific regions within Asia, we see that Nikkei is trading at around record highs as we saw some political changes over the weekend with, the Japanese PM Shigeru Ishiba stepping down. This has led to a lot of investors betting on a looser fiscal policy. And in another region, we see that China consumer prices, they fell a bit more than expected this morning, But drilling down, we note that it's more of a reflection of, volatile food prices. So all in all, Citi, we like both of these regions. We note recovery in business activity in China, and we see positive reforms and economic development in Japan. So overall, Asia is very trade heavy. So I guess we need to keep a lookout for ongoing trade negotiations as well as what's happening in India.
And going back to Singapore this time, Audrey, DBS shares hit an all-time high, helping to boost the STI to a record. I believe the record is somewhere around the closing level today. So what's your take on the STI's performance and movements relating to the trio of local banks, given this renewed look at the U.S. economy and renewed rate expectations, so to speak?
Okay, quite a lot of questions there. So I'm going to kind of let's kind of break it down, right? So the STI is up about 1% today. So this is largely tracking Hang Seng, Kospi, and Taiwan. So you mentioned DBS as well. So it's worth noting that the three local banks, it comprises more than 50% of the index, with DBS alone about 25% of the total index. So we see DBS is closing at about up 3.64% today. So this is lending a lot of support to the broad index STI performance. Going into banks, and you mentioned around the U.S. economy and rate cuts, a quick comment to make here is that banks in general, not just Singapore, but globally, banks have done very well over the past 2 to 3 years, and this is on the back of higher interest rates, because it allows banks to generate very strong net interest margins. Other factors like having a strong wealth management platform, robust trading activity, all of these have also contributed to significant growth in banks during this period. At Citi, and I'm sure at many of the other banks as well, a lot of good money is being invested in innovation, in technology, to improve efficiency and expand product offerings, which I guess at the end of the day does deliver value to clients and therefore reflected in the stock prices as well. So your final point around rate expectations, right? With rates coming down, it's true, margins may get reduced. But I think a more conducive investment climate may offset these net interest revenue with a lot of higher trading, with deal-making activity. We are seeing a lot of that flow through. So on a sectoral basis, we are actually quite overweight financials, despite all these notions of rates coming down.
Audrey, across the region, let's talk about what's going on in China. China's consumer prices slid in August while producer deflation eased. This as policymakers trying to rein in excessive competition and price cuts in key industrial sectors. I believe you're talking about the involution. So if we go by the latest numbers, the CPI was down 0.4% last month from a year ago, missing Reuters' poll forecast of a 0.2% dip. How far were the numbers in line with your expectations? What does it mean for Chinese equities?
We mentioned this briefly earlier around the coverage of Asia.
Yes.
But it's quite interesting, that the headline CPI fell to a 5-month low. But if you look at the core inflation, it actually edged up. So the reason for the headline drop was largely food, so particularly fresh food prices in China. And we attribute this more to base effect and seasonal price variations. Even though the headline news seemed quite unsettling, markets shrugged this off broadly. Judging from the flat performance in Shanghai, Shenzhen indices today. The bright spots, however, are quite interesting. So if you look at consumer discretionary and tech, both of these sectors saw increases, which aligns with our view that is overweight on China, in particular these sectors. We also saw double-digit increases in gold and platinum jewelry. So, we have been hearing a lot of clients asking us about gold, and we note that gold prices are correlated with central bank buying around the world, and especially in China, where the consumer themselves are also chipping in. So all these central bank buying, consumers buying, especially in China, all of these are supportive of the price of this precious metal in the near term.
talking about Asia, we saw shares of Asian tech firms along Apple's supply chain benefiting from the launch of Apple's new iPhone 17 lineup. Anything notable to watch on this front?
I guess Apple's event was largely aligned with investors' expectation. With the launch of their iPhone Air, updates to the Apple Watch. Broadly speaking, the upgrades didn't really seem revolutionary, as it feels like the market has kind of become numb to the incremental changes in the product line. That said, Citi still has a very good view of quality growth companies. The Magnificent Seven companies, together with other names in the S&P, they are still coming out ahead. They have visibility on revenue, AI expenditure is strong, and many of these companies have very strong fundamentals as well, like good balance sheets as well as very positive margins. So if we kind of take a step back and look at the broader index, right, our year-end target for the S&P is 6,006, which you notice it's only about kind of 2% higher than today's level. So with markets kind of priced to perfection, we are suggesting to clients to add on pullbacks instead.
Okay. And finally, before we let you go, Audrey, let's talk about oil prices. Crude extended yesterday's gains on renewed fears over the Middle East after Israel's strike on Hamas and Qatar. What are the levels to watch, in your opinion?
Well, actually, we saw very modest price action following the recent strikes. And this is probably because the market is betting that oil prices will stay relatively subdued on the back of Russian oil in the market. So we see that Trump is urging the European Union, the EU, to implement tariffs on China and India. And we know that both of these regions are the largest consumers of Russian oil. But I think across the market, there is general skepticism that these sanctions will actually be ramped up. So to some extent, there is some downward pressure on oil prices. This is also against the backdrop that, any aggressive action to trigger a rise in crude prices might lead to knock-on effects, secondary effects on inflation, which is what all the countries, especially the US, will want to avoid right now, especially since they're going into the season of potentially cutting rates. Earlier we spoke about Fed action, and we can think of a positive catalyst for oil prices. A positive catalyst could be an increase in economic activity following rate cuts when they eventually do come true. But overall, seeing that OPEC Plus is ramping up output, they're building up inventories. I think the fundamentals for oil remain relatively weak for now.
I see. Thanks so much for the insights today, Audrey. That was Audrey Ho, investment counselor at Citigold Private Client, Citibank Singapore. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.